If you are tired of always choosing the incorrect fair value gaps and losing your trades, then this video might be for you. Today I'm going to be showing you the secret to trading fair value gaps using ICT and smart money concepts. It is really not a secret, it's actually very easy, and it's been right in front of your face this whole entire time. So these two things that you need to choose the correct fair value gap are simple: the market structure shift and a reaction. So you wait for a market structure shift. After you have a market structure shift, that's when you're looking to trade a fair value gap. When price comes into your fair value gap, like in this example, you wait for a reaction from that gap. Then when you get a reaction in your direction, that's when you want to take your trade. So market structure shift combined with the reaction give you a higher probability to choose the correct fair value gap. This works way better than choosing a random fair value gap on the chart. Now let me show you some real chart examples where this happens. And this happens all the time, as you guys can see just looking on the charts. So if we look here at these examples, we'll zoom in a little bit. We have a low here, we have a high, then we break below this low. So we have a market structure shift. Then we have a gap that forms. So we have a fair value gap. Now most people would just enter off this gap. However, if you just enter straight off of this gap, you don't know if the gap's going to actually hold. How do you know if the gap is going to hold? With your reaction. So since we are bearish, we'd look for a bearish reaction from this gap. As we see this black candle, it starts reacting from this gap, going down bearish. That would be our reaction. That's when you would enter and you would set your stop loss above the reaction high. Then you would target lower to liquidity. Not only does this give you a higher probability of this gap playing out, you're also not playing any guessing games, and it gives you a higher risk to reward. Here's another example. We break below this low. Fair value gap forms. We don't take the fair value gap blindly. We wait for a reaction. What do we get? We get our reactions down here. Price starts going bearish after it taps the gap. That's when we would take our entry. We'd set our stop loss a little bit higher, and then we would aim lower. We get another breakage structure. Then we have multiple fair value gaps. You see price comes here. However, before price even reacts bearish off of this structure, price creates a fair value gap down here. So then we actually end up reacting off of this fair value gap and going higher. So this is when you need to be discretionary with this trading, because you can see it worked here perfectly, and then here price flips. This was not a good reaction. But what does price do? It breaks this high, so now we have a market structure shift. We know that we're bullish. What are we waiting for? We're waiting for price to come into the gap that it created. And we're not just going to take this gap blindly. We're going to wait for a reaction. We get our bullish reaction. Then we would take our trade and we would target higher. And you can see this was a very big move. So this is literally how it works. Remember, for choosing the correct fair value gaps, if you want to call it the secret to trading fair value gaps, you want a market structure shift and you want a reaction from the fair value gap. Those are two important concepts. Do not forget this. If you guys like this video, make sure to like, comment, and subscribe, and I'll see you guys in the next one.